Hindsight bias is a cognitive bias that describes the tendency of people to convince themselves that they correctly predicted a past event or that their prediction was more accurate than it really was. This causes investors to think they can accurately predict future events, which leads to overconfidence. As you can imagine, this bias comes into play with market crashes and stock rallies. Investors anticipating a crash that they think is imminent will almost always look back in hindsight and think that they accurately predicted when the crash happened, when in reality the exact time of a crash is largely unpredictable. This is especially true if the investor experiences losses and subsequent regret from the crash. Just because one fears a crash doesn't mean they know when it will happen. Expecting a crash doesn't really do anything for us as investors. These statements come to mind. I called it. I knew it all along. I said this would happen. Following crashes, you'll always hear pundits saying things like this and pointing to indicators that they didn't mention before the crash.